Thank you, Silvio, and it's great to see so many familiar faces as well as participants on this call. I very much look forward to a conversation. Let's try to make this interactive. It's always very difficult over Zoom, but please feel free to interrupt and jump in with questions. Otherwise, it's going to be very difficult to listen to me for too long. When Silvio asked me to prepare kind of a high-level keynote speech for this, I was trying to really take a step back and ask, what's been happening in the space over the last few years, and where do I think it's going? I think there's a number of really interesting dynamics playing out from what you're seeing in cryptocurrencies to, of course, decentralized finance or DeFi, stablecoins. As you can tell, there's a lot of regulatory attention to this space, and also central banks. I would say, the one thing that the formerly known as Libra, now Diem project that's probably achieved to date is mostly triggering a very strong public sector response. It has accelerated, I would say, the thinking within central banks around some of these issues. And in fact, in the next few months, I think we'll see a number of announcements in the US and in Europe around how some of these countries are starting to think about CBDCs. Of course, you have countries like China that are way ahead on this with DCEP. Already kind of in the piloting and testing stage with, very large number of users already experiencing the power of digital instantaneous low friction payments. So this is kind of the agenda, but again, happy to slow down in the parts that you're more interested in and to accelerate on the ones you're less interested in. When it comes to kind of an overview of this space, I look back to my office at MIT, the night where we launched the digital currency research study. This was the one that ended out, at the time, it was about $500,000 in Bitcoin. Now, of course, it's a lot more. That was in 2014. And interesting, cryptocurrency and blockchain was pretty flat then. It was mostly, in the corridors of MIT. Of course, you had people like Silvio that have been studying this space for decades and waiting for it to come to the surface and reshape the financial sector. And in the last few years, I think we've seen waves of attention. You had kind of the first Bitcoin, Ethereum, and kind of ICO bubble with all sort of projects coming into the space. And even at MIT, what's kind of interesting at the time was that students were trying to figure out what is this thing that we were distributing. Every MIT undergrad of that cohort received $100 in Bitcoin. Well, today that's worth more than $9,000. And here you're looking at the bubbles of the dorms kind of activating transactions and engaging at MIT with this cryptocurrency. Now, as it turns out, the majority of MIT students, credit to their ability to kind of forecast what this was really be used for, decided to hold on to those coins. So probably they saw it as a speculative investment bet. We were looking for all sort of kind of real world activity in payments, and a lot of that didn't happen, right? It was very difficult to spend Bitcoin on campus in 2014. There was all crypto winter, then another explosion, I think, in projects and efforts, and finally decentralized finance over the last couple of years. And what's interesting to economists, I would say, is that you have a number of competing standards. You may claim that for some use cases, whether it's digital gold or others, there is kind of a market leader, or at least a project that looks like a dominant design. But the reality is that I think we're still far away from the space settling on what the winners and losers might be. And this is not unlike other industries, right? So if you look at the early days of the automotive industry or computing and personal computing, you have waves of entry, and then over the long time you have shakeouts, and a lot of these projects may leave or be abandoned or losing popularity, and a few of these may come on top. Of course, it's very difficult to predict how all of that will kind of play out, and that's kind of the interesting part of being actively part of it on a day-to-day basis. Now, what's interesting, I think, is that each one of these projects makes different market design choices. So it's not just about different types of technologies. And of course, we'll hear, I think, from speakers that are developing very much that frontier technology every day. But it's in terms of like, what are the incentives? What is the security construct? What could bring one of these networks down if a state actor or some other type of player tried to, break that distributed consensus process? So one side, you have the crypto space, I would say, moving at very fast speed, and in iterations that become more sophisticated. When you look at ICOs and you compare it to DeFi, DeFi is a much more advanced version of some of the ideas that were incubated around ICOs. And again, further movement from protocols that are essentially truly decentralized and do not have a centralized entity that you can kind of regulate or control. At the same time, you have all of this happening in the crypto space. There's the similar wave in the public sector. A lot of this was I think sparked by our first white paper with Libra. As I've said many times, it was an extremely naive white paper. We had a lot of vision, but we have a number of gaps, especially when the public sector started looking at it and saying, well, where's your AML and CFT framework? Where are your provisions for stopping, financial crime on the network? How can you allow anybody to interface with a payment network? That's not how payment networks operate. There's gatekeepers, there's compliance, there's all these rules that we've developed over decades to ensure that payments are safe. Nevertheless, I think it's really interesting to look at this kind of tension between these two areas. The permissionless space advancing, again, one piece of code at a time, and the central banks trying to grasp their mind around how do we respond? How do we build something that makes sense so that we can retain control, for example, over monetary policy and some of the other big public sector goals. So as you'll see, this talk will kind of build around all of these different developments. But before we jump into that, I'd like to go back to something that we wrote actually many years ago. It was published only in 2020, but the original draft is actually from many years before. With Josh Argans, we wrote this piece on the economics of the blockchain, which was published in the communications of the ACM. And, like economists often do, we're trying to cheat. When economists try to understand where is the technology going and they don't know, they try to go around and try to identify fundamental costs that are shifted by that technology. Because even if you don't know which direction it's actually going from a practical perspective, what kind of projects, verticals, and use cases, if you understand the fundamental reduction in cost that the technology is driving, then it becomes very much easier to think about where will this have an impact. So if you go back to these fundamentals in terms of cost transformation, you can start saying, okay, this is a problem that blockchain can solve. This is a problem that blockchain cryptocurrencies cannot solve. And in that piece, we surface two costs. One, I think, we talk all the time about, which is the cost of verification. So the idea, for the computer scientists in the room, that you can cheaply verify state, and that operation is essentially costless. But to economists, the more interesting one is the one we call cost of networking. Some years after, I have a better name for it, and I'll tell you in a second. But when we call the second cost of networking, the idea was really that what's unique here is that you can finally bootstrap and operate a marketplace, any digital platform, without assigning control and market power to a single entity. All of the digital platforms we come to enjoy today are structured in a way where the platform architect has a lot of discretion over changes to the ecosystem and who can participate and who cannot. So the first one, again, costless verification. I think this is an example from MIT where you can verify that your certificate, your degree, you have actually earned it, instead of sending envelopes with walks on top of them and all sort of other processes that we've developed in society to verify that somebody has actually graduated and taken those courses. But I think something that is not often talked about enough is the last mile problem. When you ask what can cryptocurrencies and blockchain do today, well, a lot of it is frictions between the offline world. Think about physical verification, whether it's identity or KYC or some of these activities that do require real world information, and their online record. I think there's still plenty of opportunity in this area. And in fact, many startups, I think, that will be very successful in this space will be playing at that interface. Because if I can accurately port over information, whether it's through an Oracle or some other service on chain, now suddenly the type of marketplaces and applications that I can build are much more interesting. But the cost that, again, I think it's much more important in the long term is what we call the cost of networking. And if I were to rename that cost today, I would actually talk about the cost of interoperability. I think this is a technology that fundamentally changes how we think about interoperability of services, and of course, on top of that, programmability. And here I have a picture of the early internet, because the early internet was also about a different type of interoperability. And my sense is that as soon as the technology will be able to kind of clear some of the hurdles, and as you'll see, even with Diem, there's a number of major hurdles that well-designed stablecoin project has to overcome to get there. As we overcome some of these frictions, I think we're gonna really enter a new wave of innovation that is not unlike the one we saw with the early internet. And also from a policy perspective, I think the history of the internet, there's a great book by Shane Greenstein on how kind of the commercial internet came about. When you think about why the US was so successful at applications on top of the internet, well, first of all, decades of work and incubation within the public sector, from the very iterations of ARPANET, BitNet, and the academic applications, of course, also the defense ones. But then suddenly also the opening up of a massive sandbox, essentially, for businesses to experiment and build on top of it. That was kind of unique in the United States. In fact, countries that try to really control that process, eventually many decades after, don't have a lot of major tech players. So I think, again, here, there's an opportunity for different regions to be on the frontier in this space. And then programmability. I think programmability is extremely interesting, especially when it comes to money. Think about conditional cash payments, different forms of escrow. The entire financial sector is essentially different degrees of programmable money. And if you can bring in the right oracles, the right information, the right marketplaces, then we can start rewiring finance from the ground up. These are kind of the famous Lego blocks that people talk about when they talk about DeFi. So DeFi, decentralized finance, I think there's a lot of talk about it, but fundamentally, it's kind of the same movie that we've seen play out with early cryptocurrencies applied now to different applications. And I'll argue that it is really, again, about interoperability and programmability, this time within finance. If you think of early cryptocurrencies as experimenting in store of value and kind of networks of medium of exchange, DeFi is taking that to the next level by saying, look, the financial sector also concentrated within certain players that have a lot of controls over certain types of transactions. What if we were to open it up and make it more like software? And these Lego blocks are quite interesting because once you decompose them in their fundamental parts, they can be recomposed in different ways. And again, to economists, this is not new. I think we've seen years of unbundling of different services with the internet. Just think about your experience with cable versus today in streaming or with music. All of these services have been unbundled and recomposed in slightly different compositions. And I think consumers and businesses generally have come ahead with more choice, lower cost, and a lot more business experimentation. So you may think, DeFi, for example, is different than NFTs, but that's, again, the same process. So non-fungible tokens make content more modular. Now, again, for some of these NFTs to have real value in the long term, legal frameworks and institutions around their use and reuse will have to evolve. I think there's a lot of wave of enthusiasm around this, but now it's the building phase where, again, the technology has to close the gap between the digital representation of an NFT and kind of the rights that would come, whether it's copyright or something else. And what's exciting in the NFT space, I think, is that by making content more modular, you'll have new types of aggregators, new ways of supporting exchange that will support all of this. But let's zoom in a little bit on DeFi, because I think it's kind of interesting, and it really surfaces a major tension in this space, which is software and code that can advance really at fast speed, and institutions. The rules around those exchanges are not advancing as quickly, and so you have inevitable friction between what's happening in crypto and what it's happening in the regulatory space. And I would say this is not unlike the history of any sort of marketplace. Here we're going from the bazaar, to the Tokyo auctioning of tuna, to car sales, to stock exchanges. Society has come with very clever ways for exchange, for accelerating those exchanges, for reducing frictions in those exchanges. And of course, economists get really excited about, what auction design can we implement and what are kind of some of the parameters. And of course, also in market design and in computer science, I think there's a lot of work in thinking through, pushing these things to the next level. And DeFi, is really an evolution of this. DeFi is a way of replicating some of these conditions in marketplaces under new new types of assumptions. Now, if you take a step back and you look at what's actually happening in DeFi, these are some of the top projects as tracked by DeFi Pulse. A lot of really interesting names, but what is really happening beyond? Now, of course, as in anything in crypto, the first wave is about speculation, investment, and all sort of arbitrage that people have identified in the existing rails or even in the existing crypto services. But just to give it some structure, I would say there's 4 major categories of DeFi applications. So the first one is decentralized exchanges, which essentially is saying, look, exchanges have become a central point of failure in crypto. If somebody has your keys, then potentially that's not your money or your coins, and they're subject to all sort of cyber risk and other attacks. Of course, there's technology and protections even when it comes to disclosures and consumer protection that can make exchanges much more reliable. But the DeFi pitch is essentially saying we don't need an intermediary. We can provide a protocol where maybe instead of having an order book with a ask and a bid, we can trade pairs based on quantities. So economists will find this kind of interesting. Is like instead of trading on prices, the majority of decentralized exchanges in DeFi rely on kind of liquidity pools. You have pools of both coins, and the relative quantity between those two pools essentially sets an exchange rate. Of course, you have slippage like in any other system, right? If somebody comes in with a large request for moving from one pool to the other, and there's not enough liquidity, you'll have to pay a premium. What's fascinating here is that if you take a step back, now you have a way for going between one digital token, one crypto token, and another without anyone being involved in the picture. Someone needs to, essentially release some code, and that could be, an anonymous entity too, like we've seen, for example, with Bitcoin. And now everyone can essentially exchange these digital tokens with another without any form of regulation, any sort of legal framework, any sort of friction. And that's both good and bad, right? Because I'll get back to this, but we have rules and regulation around these exchanges really to protect consumers and to achieve all sort of societal goals, including keeping bad actors outside of the financial system. So that's the first category, and it's one that is delivered higher efficiency and connected different parts of the crypto landscape that weren't connected before. The second one is, what I broadly categorize as collateralized lending protocols. Now, people don't usually think of things like algorithmic stablecoins as collateralized lending, but when you think about it, when I'm issuing an algorithmic stablecoin, whether it's DAI or something else, what I'm really doing is I'm depositing something as collateral, and I'm getting a new token, which is typically a dollar-backed stablecoin or dollar-pegged, ideally dollar-pegged stablecoin in exchange. So it is a form of collateralized lending, right? Somebody's giving you one asset and you're issuing a claim that is meant to have different properties. Of course, there's all sort of other platforms that facilitate kind of borrowers, where somebody can bring one token and borrow another, all sort of applications for that. A lot of relates, of course, to financial leverage. And then there's this interesting set of applications around wrapped versions of other digital assets. Say you have an asset on a more conservative, slower blockchain and you want better properties. Now you can wrap it and use it on a better blockchain or a blockchain that fits your immediate need. It is a form of collateralized lending. People don't think of it that way, but wrapped coins are collateralized lending and are exposed to some of the exact same risk. In fact, often, wrapped versions are centralized. And so now you have a single point of failure in the wrapping. Although, of course, people, of course, are working on models of wrapping that are more decentralized. There's always interesting tensions there between kind of the simple solution and the one that's actually more resilient. Beyond collateralized lending, I mean, decentralized exchanges and collateralized lending are really the bulk of it. There's new, more embryonic stuff around asset management. Now, these investors and speculators want to optimize crypto portfolio returns. And what's interesting is that these instruments get very complex. It's code, building on different assets, with all sort of algorithmic rules. Andrew Lo at MIT has this fantastic talks where he talks about the flash crash. I think when you look at some of the situations, a lot of that could materialize in these marketplaces because the instruments are getting more and more complex. And then, it wouldn't be decentralized finance if you didn't have derivatives, of course, from prediction markets to insurance contracts, ETFs, you name it. And this is an area that's exploding, again, In terms of practical use cases, not a lot. I would say the main ones are still the decentralized exchanges and the stable coins that are used through collateralized lending. But again, this is what's coming kind of up next. And if you were to ask, what are some of the key risks here? Of course, as anything crypto related, there's smart contract risk. And so if you don't have a language that's formally verifiable and you're not careful, let's say you're fully Turing programmable, what is the attack surface for some of these contracts, especially as they start carrying, say, millions, if not billions of dollars of value? Then there's more traditional and boring financial risk. Many of these collateralized lending platforms try to set some interest rate, whether it's manually or through algorithm or through some form of governance. In general, I don't think users are really aware of the economics of those mechanisms. And so they're probably exposed to a lot more risk than they think so on a day-to-day. I would say the biggest one, though, is really systemic risk. You have multiple layers of risk between all these different protocols and interdependencies. And it's very difficult to map them out. So a lot of this looks, like 2008, where we had these very sophisticated instruments and insurance contracts against those, repackaging of, mortgage-backed securities and the like. And as things get more complex, it's very hard for humans to understand what is the degree of leverage in the system, what is the degree of actual risk, and how quickly could all unravel. Here's a really basic example. There's a lot of DeFi on top of stablecoins today. But when you think about it, a lot of DeFi is essentially shadow banking. You're taking some of these tokens, you're issuing some new claim. Now, what's interesting is that, of course, technically, the breakdown of a DeFi application should be contained within DeFi itself. Well, not so fast, right? So many of these DeFi applications run on the same blockchain that the stablecoin runs on. And so if you have a massive outflow, imagine a massive run out of a DeFi collateralized lending platform. Well, now that blockchain is going to be under stress, and moreover, there's going to be panic. And so maybe people getting out of DeFi will not only go all the way to a stablecoin, but will also say, wait a second, maybe I should go back to fiat. Maybe it's so dire that instead of holding my stablecoin, I actually want money in my bank account. If that happens, a run in DeFi could really trigger the breakdown of a stablecoin itself. And I'll talk a little bit more about this in the next slide. The last item is regulatory, right? And this is kind of the cat and mouse game between the systems and regulation. If you think of ICOs, most of them really failed because they were the sale of unregulated securities. And that's a really simple activity for the SEC or some other securities regulator to tackle. And in fact, many of these projects were shut down because they didn't have the right structure. But with DeFi, there's no intermediaries, right? So it's not like an ICO where you're raising fiat, maybe in exchange of tokens. With DeFi, you're releasing a protocol. Of course, there's governance tokens and there's all sort of ways that the founders can benefit from that. But technically, a DeFi protocol could be released in the wild and regulators wouldn't really have anyone to regulate. So they look a lot more like Bitcoin than they'll do like initial ICOs. And this is, again, that really interesting challenge between what we're seeing on the regulatory front and even the public sector thinking around this and what's happening in the wild. You often hear the narrative that all of this space is about removing intermediaries from the picture. I would argue that it's actually much more about changing the nature of intermediation. And in fact, when you think about some of the long-term upside of this entire space, that will materialize not only as we remove intermediaries, but actually as we replace them with more efficient, lower cost, more interesting intermediaries, or we get those incumbent intermediaries to play by new rules and be more competitive. The challenge, though, is that as you remove intermediaries from the picture, again, as a regulator, you're often in charge of the safety of a marketplace, ensuring that there's no insider trading or there's no market manipulation going on. When you do that, sure, you can rely on efficient markets, but more often than not, these crypto markets are not as efficient as people believe them to be. And so we wrote a piece with Zaima Sari from Davis Polk. She's a lawyer studying kind of a lot of the landscape here. And one of the key questions we ask is like, if you remove intermediaries from the picture in DeFi, how do you really ensure that these marketplaces really reflect society's values and principles? There's a number of reasons why transparency, automation, more competition are really good. But how do you stop, insider information, manipulation of the market, destabilizing the system if it's for your own benefit? these are not new problems. And I think, people that have been developing protocols so far have faced all of these challenges. But with DeFi, they're just exacerbated. And I think what's really interesting here is that for the first time, regulators have to regulate a space without having a touch point with the intermediaries that they would typically interface with and set rules for. I see there's a question. Before we go there, one last point is that, if you look at the evolution of crypto, we've seen this movie before, right? You had things like Bitcoin and Ethereum and others. As they've become more mainstream, exchanges have become a lot more regulated. And so you have KYC, you have onboarding. So I think we should expect something similar within DeFi. And that's, again, that back and forth between public sector requirements and financial requirements, compliance requirements, and what's happening actually live in the space. I see there's a question, so happy to take it as we go.
Hi, Christian. This is Andrea Civelli. I have two questions that are related to each other, probably, and to the intermediaries topic that you're covering now. If we had just regulation, even without intermediaries, do you think it would be enough to have to solve part of this problem, in particular when we talk about initial coin offers? And about the ICO, do you think the problem there was that these products were offered to a broad audience of people that were not financially educated, let's say, they could actually understand the product they were buying, or it was a more structural problem about the underlying value of the product that were sold? I mean, not sold, offered.
No, that makes sense. So on the first one, I think regulators will eventually figure out a way to regulate the activities rather than the intermediaries. So there might be ways to actually ensure, maybe they'll have to start, writing their own code or having their own interfaces with some of these protocols. But you can imagine a world where you achieve the same societal goals, just in a different way. All we're saying in this piece is really that it requires a mindset change, because, whether you're the SEC or the CFTC or any other regulators like them, in the past, there was a very simple way to go to knock on the door of the intermediary and say, okay, from tomorrow, you're going to do A, B, and C. Now there isn't such a thing. And so you're switching really mentality. Now you're approaching the spaces. I think technology can actually be the solution. And in fact, these are markets that create more transparency. They're programmable. There's benefits that could be really revealed here, but we also need to think about some of the dark side of some of the applications, right? To the point about ICOs, I did study actually the economics of crowdfunding for many years before coming into kind of crypto and blockchain. Crowdfunding faces the same challenges, right? Which is the early crowdfunding was kind of the Wild West. Everybody was funding out of the goodness of their heart. Then there were scams, right? Then there were less serious projects coming in and taking advantage of the enthusiasm. ICOs, I think, were the same. You had some really well-motivated, developer teams that were doing the right thing. They were trying to raise capital, build a really interesting protocol. And then you had, of course, people that realized, oh, this is a really quick way to raise millions, if not more, in money without any of the protections that investors would typically have. And that's where, again, we do have frameworks for thinking about consumer and investor protection in this case. And if you're making certain disclosures or promises, you need to be held accountable to those. The challenge is that, by the end of it, I think most of the ICO activity was actually either projects that were straight up frauds or projects that weren't that serious. Like they didn't have the right technical team, they didn't have the right technology, didn't have the right business experience. And so it was very difficult to separate, a really well-structured project from a bad one. Most of that disappeared. And of course, there are ways that, DeFi and crypto projects can raise capital. But over time, I think, there is potential, I think, in expanding the set of investors that you raise capital from. But I think that should still be done within some of the frameworks that we developed over the last few decades around securities issuance. Okay, there are not follow-ups or other questions. I'll keep going a little bit. So we wrote this piece with actually Ravi, who is going to be presenting in the conference a bit later on another paper that we worked on, and Scott Commoners. Mostly to surface that, people often think of this space as software eating the world, right? So to go back to Mark Andreessen's famous quote, this is just another instance where you bring in software and, you're changing the society and the economy. I think it's a little bit more nuanced here. I think here you have a very critical interplay between another type of software. We don't think of institutions as software, but I'm sure some of the computer scientists in the room today think of institutions as software. And so I think what's happening right now is that we're upgrading our crypto software very quickly, and our institutional software is struggling to catch up. And in fact, it's turning off all these errors, which is like, no, we are not supposed to do this. And you can't do this, so you're going to run into this other problem. But to unlock the potential of everything happening here, from crypto, store of value, medium of exchange, decentralized finance, and eventually even decentralized autonomous organization and more, we do need to bring back the right frameworks. Even NFTs, right? If you think about content, wouldn't it be great to have a concept where it actually maps into copyright law? And so, you're not just transacting a basic bragging rights, as somebody has defined some of these NFTs, but they do have real world properties, going again back to that online-offline divide and that last mile. If you can have some of that interface in place, these NFTs become a lot more valuable if they actually translate into real world royalties that you can defend and protect, right? So intellectual property can really create new types of marketplaces where there aren't. And so I think it's important to see these legal frameworks evolving. That said, again, the technology is also really good every now and then at creating completely new marketplaces and ideas that you couldn't even imagine. And taking a step back, look, why am I still excited? I think, I started looking at this actually in the late years of my PhD, so way too long ago. And I started doing research in 2013. So we're almost, 10 years in from that, but I'm still excited about the long-term benefits of the technology. I still fundamentally believe that, this can bring more competition, innovation, and choice, both for consumers and businesses, through a few basic levers. The first one is, again, something that people think of it as pretty boring, but I think it's extremely important for competition, which is interoperability. When you make services interoperable, and I'll talk more about this in the context of Diem, suddenly if I'm on a small wallet that's just starting, a small startup, I can send money and payments to a large wallet. And so very much like compatibility in software, right? Think about the early days of Mac versus PC or, Office solutions. Interoperability is the key to giving consumer choice and driving competition on different aspects, rather than how large is my user base? What can I do once everybody is on my platform? It's a technology that, if used correctly, and this also relates to CBDCs, can lower barrier to entry for new types of players, and also lower switching costs and lock-in. Consumer lock-in often expresses itself in many different ways. But here you not only have lower switching costs, but you also have the further unbundling of things that were kind of bundled together. Think about, banking or payments, right? In payments, we often use a credit card. That's the bundling of credit and payment. Those two things don't really need to be bundled together in that form and shape. And unbundling them allows for more choice and lower cost, typically more competition along those dimensions. The other very interesting area is privacy. We're people like Sylvia here today that have been thinking about very deep issues around privacy and zero knowledge for many decades. But once you take the technology and start thinking about what can we do, then some of those trade-offs that we tend to think of, like, okay, can we make this coin both private and compliant so that, if there's a regular law enforcement request that's approved, that transaction could be revealed. Those two are not trade-offs anymore. And you can also get increased transparency and accountability without maybe revealing everything at every step. So part of the the long-term benefits, it's some of the things we're trying to do with Diem, and I'll talk a little bit more about the project. It has changed dramatically from the white paper 1 and kind of the early Libra. And I also want to put it a little bit more in the context of stablecoins in general. I think this, not surprisingly, is a space that is exploding, and for a number of really good reasons. It is kind of the on and off ramp to fiat, but it is also how I would say the crypto space is essentially lifting off and detaching further from the traditional financial system by recreating some of the good properties of stability on its own rails. Massive explosion. This is kind of a chart of the last few years, but just look at what happened after COVID. There's been kind of a massive growth in all of these networks. A lot of it is, we looked at the data, it's actually driven by DeFi. So interestingly, if you're doing decentralized finance, you do need a stable-ish asset to rely on. And this explosion has also driven a lot of attention from the regulators. Here's Lael Brainard, governor at the Federal Reserve Board. She actually compared stablecoins recently to the period of wildcat banking. Now it's interesting because once you dig down into the history of wildcat banking, it turns out it was a much smaller number of banks that we think of. It wasn't just the entire banking system in the United States. But the basic intuition is that when money was privately issued by banks with little oversight, very much like some of these stable coins, then suddenly it could be very dangerous. And I think she's right. The word stablecoin is a misnomer. We call all of these things stable coins, so they're supposed to be stable against a reference asset. But what's really interesting is that once you look under the hood, there's a basic promise, right? I'm putting something in a reserve and I'm issuing a new token. Let's say it's a dollar peg token. But what I'm putting in the reserve turns out matters a lot, right? And when you think about the volatility against the asset that you're pegging against, you have things that are completely not correlated, say with the dollar, and have things that are perfectly correlated. And in fact, a CBDC is kind of the gold standard for a stablecoin. The central bank will control both the token and of course the underlying asset. When you move on the left, we have a lot of instruments that are being generated today, now with very great economic thinking, to be honest with you. Some are crypto backed, so you're putting crypto in the reserve, and even under collateralized. These are very popular designs. I don't think people realize how popular they are, but essentially they're using their own governance token or their own investment token as backing. They don't say it in these terms, but when you look under the hood and look at the economics of the model, that's what they're doing. Now, why is this terrible? It's because that governance token is completely not correlated with the dollar, right? And in fact, it's very positively correlated, perfectly correlated with the expectations about that ecosystem. So if I'm launching a stablecoin that's backed by my own investment token, and I start to enter, dire straits, that stablecoin collapses to zero very rapidly. We've seen it for small stablecoins. I think it's going to happen even in larger ones. It's a major threat, I think, to the stability of these assets. The way to actually do a stablecoin with crypto is to over collateralize it. Of course, it's very expensive. You're kind of putting $1.5 for every dollar you issue, and you kind of automatically liquidate if there's a shock. These designs have been a bit more reliable, but of course, if the shock is big enough, they'll also run into a break of the peg. Then you have kind of all sort of supposedly fiat-backed stablecoins with different levels of transparency. And even the so-called regulated stablecoins, when you look at what they're using in terms of assets, they're not using high-quality liquid assets, and they don't have the typical capital requirements and buffers that you would have in the banking system. So they're kind of a very early version of what you actually want to see in the hands of consumers. The other dimension that people don't talk enough about is the debt spiral. So some of these stablecoins today are really at risk, and you don't need to worry too much about the graphs. And the economic intuition is pretty simple: is if I'm backing a dollar-based token with my own investment token, as my platform grows and does well, of course, I'm likely to be over-collateralized. But a shock in expectation, a shock in the confidence in that system rapidly precipitates into a full debt spiral. And what's really interesting is that these investment tokens almost create a reason to run on the reserve even when market conditions are good. So as long as people believe there's going to be a run materializes, the coin collapses, and so these are terrible, terrible ways of creating stable assets. And I think we've seen this in a lot of the algorithmic coin models. Again, this is a very simple version of it, but what these algorithmic stablecoins are trying to do is they're trying to issue a new token. In fact, there was a famous project that was not even launched, Basis, that had a slightly different model with senior shares, but these all look alike. What they're essentially trying to do is to issue their own governance token. It's almost like a central bank going out to issue more liabilities and try to bring money in so that they can meet expectations. But as you can imagine, right, by linking these two, it becomes more and more expensive for that stablecoin to defend its peg as the situation deteriorates. Very much like an unsound currency board. I mean, we've seen this over history many, many times. A small shock can lead to an initial run. That initial run leads to a loss of confidence, more loss of confidence, more running, and eventually the whole thing is like the central bank trying to stop the outflow of capital in 1929. So not only have this dimension of volatility against the reference asset here on the horizontal axis, but you also have the likelihood of a debt spiral. And there's a number of stablecoins out there right now that do have this risk. By the way, a coin that is subject to a debt spiral is also impossible to safely unwind. It's a bit like a Ponzi scheme. The moment people start wondering about, okay, should we get our money back? Everybody runs, the coin collapses, and nobody gets, most of the value that they want. So I think we should be a lot more careful with these coins that are backing with investment tokens of any type, whether they're calling it, the gold token, the silver token, or the special token. These systems are inherently very fragile. And again, I mean, economists have seen this for many years. Often, I think computer scientists and the economists are very clever at creating what they call solutions to stop a run. It turns out that those solutions are actually worse, right? Because since they're known or become visible, they just exacerbate the run. So they're kind of literally mechanism for pouring gas on fire in a crisis. And it's not unlike, when in 1929, you had a series of smaller bank failures, and then the Bank of the United States, as it was called at the time, decided to close a bunch of branches down. Many of these algorithms do exactly that. They increase the tax that you pay if you're trying to get out as the run becomes more severe, which only incentivizes people to run even faster and even earlier. Like in 1929, those measures did not work, right? Rather than slowing down the crisis, when the branches closed, general panic, hundreds more bank failures and the Great Depression. So I would caution people to be very wary of these mechanisms. And really, if you want to build a decentralized stablecoin today, you either are going to heavily over collateralize it, so it's going to be very expensive, and you kind of have some conditions under which it will maintain its peg, or that there's a debt spiral risk, and so you're taking a lot of tail risk of what could happen in a major crisis. And I see there's a question.
Just a clarification on the previous slide that you were discussing. The problem there, I didn't understand if it's a problem of like maintaining the peg, or if the problem of the underlying asset that goes belly up. It seems to me maybe they are connected to each other,
right?
Yeah.
So yeah, the sequencing is essentially that because these coins issue an investment token, right? And that investment token can be worth a lot if the stablecoin ecosystem grows. The moment those expectations change, say that we expect the stablecoin ecosystem not to grow anymore or even to decline, now that investment token rapidly becomes insufficient for meeting redemptions. And if people show up and want to redeem the dollar peg asset for the investment token or whatever, that kind of algorithmic central bank cannot meet its demands. This is really not unlike, again, unsound currency board, where if some of the assets are really linked to the solvency of the local government, and you're unable to print more money. In this case, of course, the more money you print, you're trying to issue more investment tokens, the more you need. It's very much like, with hyperinflation in central banking. But I don't think people have focused on this issue enough. And then they're surprised when some of these stablecoins really kind of collapse under their hands. So really briefly, I think I only have about 10 minutes left. And please let me know how to arrange the time. With Diem, we had to make a lot of choices to really optimize this for payments, from the design of the reserve to bringing in compliance to even changing some of the features of the protocol. Happy to talk about it more in the Q&A. But when you ask what is the problem we're trying to solve, is like basic access to the financial system is really bad. Even if you take the United States, actually the United States is the worst country in terms of unbanked population among the G7. Here you can see, among, of course, the richest 60% in the United States is only 1.6% is unbanked. But if you look at the poorest 40%, it's more like 15%. And the United States is just an example. I mean, we typically think of the United States as kind of ahead, given the key role it plays in the financial ecosystem. But the reality is that the US is really lagging behind on everything from payments to eventually some of the banking and financial services. Payments are extremely expensive. A quarter of US payments relies on cash, and that costs about $40 billion a year. You've all experienced it. If you transfer money between banks and you want to do it the same day, it's between $10 and $35. 2 days, $3. Meanwhile, look, in the UK, people can transfer 24/7 practically for free on a system that clears 8 million transactions per day. Even the basic element of being kind of part of the payment and financial system, which is having maybe a basic checking account, extremely expensive, average of over $7. But that really hides a massive disparity, both in race and of course in income. So Black and Hispanic pay about $12 a month for the same services, often because there's minimum balance requirements, and essentially the wealthier you are, the cheaper the financial system is to you. There's actually empirical research looking at bank consolidations to kind of find some sort of natural experiment or shock to some of these costs. And when there's bank consolidations, of course, you know, a lot of this is endogenous to economic conditions, but some of the estimates show that not only you have higher fees coming in and higher minimum balance requirements for checking accounts, but more people go off the banking system. They become unbanked and start using these very expensive check cashing facilities. You know, there's more unpaid debts, there's more evictions, really bad consequences of less access to the banking system. Card payments, I mean, we all think about credit card rewards. Of course, that's only part of the story. On average, more than 2% is lost. And of course, consumers see this in terms of higher prices. Even remittances, you'd think that a country like the United States is the largest remittance sender, over $70 billion a few years ago, a year. The average is 5%. So it's extremely expensive to send money abroad. The internet has made a lot of things instantaneous and practically free. Money transfer, not so much. In other parts of the globe, again, Asia, all of this has already happened, and it's way, way cheaper. For example, to use an Alipay or WeChat to move money around instantaneously. There's also unequal access to the banking system. 7% unbanked, as I've already mentioned. But again, there's disparity in income and again in race. So some of these Black and Hispanic households are way more likely to be unbanked. And of course, some of that is also related to the income distribution, but it really exacerbates inequality in the country. So with Diem, really briefly, I mean, there's a number of dimensions that we're trying to really get right in terms of getting an efficient payment network. Strong protection in the reserve design, so very much trying to address all of those challenges that I was showing on the previous graphs. It is a member-based organization, and the business model is going to be extremely small. So think about single basis points transaction fees on the network, and potentially higher fees for added value, smart contract-like applications, which we call Move. In terms of the consensus algorithm, we decided early on we didn't want proof of work for a number of safety and also energy consumption implications. Ravi's going to talk a little bit more about some of the security implications and how we've been thinking about store of value versus minimum of exchange in the conference. But more broadly, we tried to find a hybrid model that really takes advantage of the fact that we do have members that can run and secure validator nodes, and eventually also open that up to competition. And so we're thinking about, with Ravi and Scott, about different models for auction design that would really enhance what is starting as a BFT, closed permission consensus model, and then opening it up to look a lot more like the permissionless ones in terms of its economic properties. At a high level, so key dimensions on an economic perspective, it needs to be an open technology standard. I've already talked a lot about interoperability and really ensuring that there's low switching costs. And there's also a really important commitment, because a CBDC will always be the gold standard when it comes to a token for consumers and businesses. We are the only stablecoin project that has publicly committed to phasing out our own token when a CBDC becomes available. We think that's really important, and it kind of shows that we think of stablecoins almost as a retrofitting exercise, as a temporary exercise where public sector rails have not been upgraded yet, and we want kind of all of those benefits in terms of lower cost, lower friction today. Of course, programmability is another important one. The other main reason why we're really building Diem is that no stablecoins today really complies with high standards for consumer protection, whether it's the reserve design, ensuring that the coin does not interfere with macroeconomic policy. Think about emerging markets and issues like dollarization. You need protections for that. Otherwise, these coins will be blocked out and will cause financial instability locally. The other key dimension beyond the reserve is going to be financial crime and compliance. How do you ensure that the system, for example, follows the travel rule, follows sanctions, and all of these other protections that we have in the financial system? Now, the way we're probably thinking about it differently than other projects is that we do think of a stablecoin as very much as public-private partnership. And in the very last few minutes, I want to kind of give a glimpse of how we're thinking about this, especially after 3 years of heavy engagement with central banks and other regulators. There's a really interesting discussion paper that the Bank of England released in 2020, which I would recommend everybody kind of take a look at if you're interested in CBDCs. Bank of England made it really clear. We can't build really a CBDC without private sector involvement. Sure, we can build something that's resilient, fast and reliable, but it's not going to be open to competition. It's going to be slow kind of at innovation. And so how do we build around the different strengths of the public sector and the private sector? Moving to the United States, I think there was a really interesting presentation by Vice Chair for Supervision at the FRB, Randy Quarles. He made the point that, look, stablecoins and what's happening in this space is not a threat, it's an opportunity. The federal government has always supported kind of private sector innovation, especially when it's responsible. There's a lot of benefits, even in terms of, the role of the dollar. And, people that are saying that stablecoins are a threat to monetary policy essentially are ignoring the fact that, money has been a public-private collaboration between, the Federal Reserve system and the banks, so private institution for decades. So there's nothing new here from a monetary policy perspective. Now, of course, he also said that robust economic design matters. And of course, they at the Fed, they have legitimate, as he poses it, and strong regulatory interests to ensure that these things are designed right. And I'm sure when they look at some of these designs, they realize that these are a massive threat to consumer protection and financial stability if they were to ever scale, even beyond what they are already today. So a number of things, right? So the structure of the reserve, do consumer have a claim against those assets? Are these assets liquid so that they could meet a run? And more on what you would want to be able to stymie a run. And there's this continuous debate, should we do CBDCs or not across many regions? I think Quarles is also stressing that, look, if we have upgrades to our RTGS systems, think about FedNow, if we have stablecoins coming into the picture and being regulatory, meeting regulatory requirements, then we may not even need to build a CBDC because we'll get all of the benefits of faster digital payments without, embarking in this long journey and very complicated one for the public sector. And in fact, if you look at another central banker here, Mark Carney, which is served both at the Bank of Canada and Bank of England, he has an even simpler solution. It's like, why don't we just give these new players, these new networks, equal access to central bank facilities? Of course, that would come with a cost, which is you'll have to be regulated in the same way. You'll have to meet the same consumer protection and financial stability requirements. There's many ways to really develop sound money and sound payments. And I think it really comes down to this last slide on, public and private at different comparative advantages. When it comes to monetary policy, stability, preservation of value, that's the job of the government, right? And the public sector can do much better. Of course, the public sector can also ensure that everybody's playing by the right rules. We want to protect consumers. We don't want to give them a coin that could run its value to zero. We also don't want a coin that's going to create havoc in an emerging economy because it accelerates dollarization and instability for the local market. Public sector can also play a role in ensuring that these networks are interoperable and don't become kind of walled gardens. There's a lot of work that the public sector has to do for this to be truly global in harmonizing legal frameworks and also tackling issues such as privacy and compliance. But the parts where the public sector will never have an advantage if they want to develop this top-down, like some countries are proposing, is in developing those consumer and business experiences. The private sector, private networks will be much faster, right? And the developing teams that we've seen really innovate really rapidly over the last few years in crypto are a testament to that. So I want to conclude by really surfacing back that picture of the early internet. I think this is an area where there's been a lot of innovation, and now it's time to upgrade the software of our institutions. And part of that will have to take the shape of a public-private partnership. This is our two snapshots of the internet, one in 2003 and one in 2010. And look, just in 7 years, the explosion of connections and activity. I think we can do all of this for the financial sector. We just have to create the right frameworks. Thank you very much for listening in, and I look forward to any questions, whether in the chat or live, depending on how much time we have left.
Thank you very much, Christian, for a great kickoff of the workshop. We really appreciate it. Jing, you are in charge of the questions because of my ability to interfere with, with the internet is proverbial.
I don't see questions from the audience. Chivo, do you have other questions?
I might have a very little one, if you don't mind, Jing. Like Christian referred to the fact that like Diem might be replaced by CBDC, or like you are willing to withdraw the project once CBDC are established. But then you say like there is this private-public interaction and cooperation that is necessary. Why do you think a stablecoin like Diem is not like compatible with like a CBDC system?
Oh, quite the opposite. So we actually do believe that it is designed to be completely compatible and interface with CBDCs. The part that we would be phasing out is not the network, right? So that's where a lot of the value in payments and financial application come from. We'll be phasing out our token. There's no point for a Diem dollar. If you have a dollar issued by the Fed, we'd rather move that one on our network because it's going to be a much better asset, no matter what we do in terms of design and user protection. So we see a future where, again, you may have a stablecoin for a few years, and then when there is a digital dollar, you take it out. And we've actually also changed our business model. Most stablecoins today heavily rely on interest on the reserve. You know, there's some public disclosures by some of them that you can look at, but that kind of becomes very difficult because if you have a CBDC token, that may not come with any interest. And so we have to change our business model to really ensure that we're fully upgradable to a CBDC when it's a possibility.
I see there is a question from the audience. DAI seemed extremely stable even during the recent crypto crash. Isn't this a good case for algorithmic stablecoins?
So that is a really interesting question. And it turns out that the stablecoins that are algorithmic, that were able to maintain the peg in some of the crashes, are the ones that have a disproportionate share of their backing in centralized stablecoins. So when you think about it, why are they able to withstand some of these shocks? First of all, it's because these markets are not at scale. And so if you have a larger panic, you have major dislocation, even some of those could run into bigger problems. But the other one is that when you look at their backing, they're often using a lot of their centralized counterparts. So they do inherit stability and probably some of the safety assumptions from some of these other stablecoins that represent a large share of what they have essentially, quote unquote, in the bank.
Filippo from the audience has a question. Philip, I think you can unmute and ask your questions.
Okay.
Although we only have 1 minute.
Can you hear me?
Yes.
Okay, perfect. Thank you. My name is Filippo. I just had two quick questions. So if I remember correctly, the presentation of the Fed speaker that you were mentioning in your presentation was also discussing the fact that, as you also said, like the UK and Asia already have like very fast payment system without having like actually CBDCs or these kinds of stablecoins. So what will be like your response to that? Like why they're really necessary? Second question, I think that one of the things for which like central bankers are maybe excited about CBDCs are the fact that they may be used for policy as well, as you also mentioned, like programmable money, cash transfer, and so on. And so if we go with like stable coins and private issued stable coins and this kind as means of payment, how could we think about using policy without having a CBDC? Thanks.
Yes, let me start from the second one, right? So again, I think if you have a digital token that's available to retail users, I think you have new types of levers anyways. And the same way, you know, you transmit monetary policy today through the banking system, you could do that and then on top of that, use some of these other networks. So I don't think the structure, and whether you call it a CBDC or not, if you have a retail facing stable coin that is integrated with a central bank, it looks a lot like a CBDC, maybe a hybrid one of sorts. But I completely agree with you. I think a lot of the excitement around CBDCs should be about what else can the public sector do, and what else can you kind of really target interventions. Think about just what happened with COVID and the slow distribution of cash transfers with checks and the like. What becomes possible? And I think you're already seeing some central banks, whether it's Sweden or China, really thinking through, what are the levers? I think there's also like, and this is kind of a tricky area because there's of course privacy implications, and you can imagine abuses of the system. But a central bank having access to better aggregated information of what's happening in the economy could be very helpful for policy too. To your point about the upgradability of existing systems, I think the public sector should just let all of these options compete. It might be that in some regions, and we've seen it, take India or Mexico, upgrading RTGS or real-time gross settlement systems was enough in delivering a lot of value. And you have UPI in India where costs have come down dramatically in terms of like what consumers experience from moving value, or even what merchants pay a payment service provider when they want to accept payments. So these alternative networks that are not blockchain-based or not crypto can deliver a lot of value. They do not tend to change market structure that dramatically, right? So it's still the same institutions that have access to those systems. Expanding access to those systems is still very slow. And so I think the upside of also engaging with stablecoin eventually with the broader crypto ecosystem is that it is a completely new way to wire the payment and financial system. And so I think it will lead to a lot more competition and innovation than just taking what we have today and the same types of institutions. It's not that digital money and digital payments weren't available for probably already 20 years. Why haven't we seen those institutions innovate? And I think as an economist, it really boils down to market structure and incentives. If you're enjoying high rents from the current system, if you can charge merchants interchange fees and all sort of other hidden costs, why change until you're kind of forced by a new type of player?